Hello and welcome everyone. This is Jason with Top Shelf Traders. I hope everyone's having a great day so far and a good start to their week. We're going to use the questions box, so just go ahead and give me a quick yes and yes. Yes that you can hear me okay, and yes that you can see Carly's screen okay. Perfect. Thank you. All right. We're thrilled to have Carly Garner with us here today. She's a veteran of the industry, and she's going to be talking with us about day trading the E-mini S&P using weekly options. So on a regular basis, we survey our entire universe of now over 600,000 traders and investors, and a huge chunk of folks are constantly looking for strategies related to options and options trading. And this is not something that we've historically talked about. So we have an ongoing relationship with Carly and her company, DeCarly Trading. She's the author of a handful of books, which we have excerpts of on Top Shelf Traders. She is also regularly referenced on Mad Money, Jim Cramer's program on CNBC, and a regular contributor to The Street. So it's a privilege to have her here with us. And for those of you that were registered last week, I'll do the mea culpa now. The technical difficulty was 100% us and me. So thank you for still joining and coming back. And Carly, thank you for coming. It's great to have you.
Thanks, Jason. I appreciate it. It's a pleasure to be here. And I hope that we all walk away from this knowing with a little extra information and maybe something that'll help you in your trading, whether you're trading options or futures or day trading or position trading. I think you can use some of the things we talk about to apply to what it is you're doing.
Perfect. Well, I'll just mention for the group that's joined us here so far, and as folks continue to filter in, as always, if you have questions, go ahead, throw them in the questions box. Carly, I will man that for you.
Okay.
And if you, for whatever reason, have joined us, but you need to duck out early, as always, this is being recorded. We'll get a copy of the recording or a link to the recording out to everyone. So, Carly, I will put myself on mute, and I will turn it over to you.
Okay, sounds good. All right, so today we're going to talk about day trading using weekly options, and these are weekly E-mini S&P options. A couple of years ago, this would have never been possible. The weekly options are a new product that the CME put out. In the beginning, they were on the illiquid side. There weren't a lot of people trading them, but the liquidity has quickly picked up, and it's actually become a great product. We use the weekly S&P options for hedging some of our short option positions, for hedging some of futures positions, that sort of thing. And then what we're talking about today, you can also use them to day trade. It's actually an interesting concept because you kind of take the best of both worlds, the excitement of day trading, the unlimited profit potential of day trading, but the limited risk of option trading. So it should be a fun topic for you. If you're not aware of who I am, my name is Carly Garner. If you have any questions or anything, you can reach me at this phone number, that email address. And if you want to learn more about trading futures and options, we have about 35 free videos on our website, as well as opportunities to sign up for free trials of our newsletter and that sort of thing. If you're on social media, we'd love to see you there, at Carly Garner on Twitter. We're on Facebook and Instagram. We try to post a lot of charts and commentary on the markets, sample newsletters, that sort of thing, but we also post pictures of dogs. So if you like dogs, check us out on social media. I am a broker, a strategist, and an author. I write a stocks and commodities column. It's a monthly magazine. I also contribute content to Jim Cramer's Mad Money. Most of it crude oil, gold, the commodity side of things, but every once in a while we'll contribute content for stock indices and treasuries and even currencies. Our clients enjoy two newsletters. Well, I should say, we hope they enjoy two newsletters that I write, the DeCarly Perspective and the Financial Futures Report. In the DeCarly Perspective, we put out very specific trading recommendations, most of them option-oriented, most of them premium collection-oriented, but we tell people what we like about a certain position, why we like it, what the risk-reward is, and we guide them through the entire trade. So as Jason mentioned, I've written 4 books. I've written a couple of these more than once, like different editions. So this is my life's work. If you know the basics of trading, you're probably going to want to jump right into higher probability commodity trading. If you're looking for beginner stuff, A Trader's First Book on Commodity Trading is a good place to start. Okay, so let's jump into it. First, I want to make sure everyone understands that there is a substantial risk of loss in trading futures and options. It's not suitable for everyone, and I'm going to show you today a way to day trade with relatively low risk, but that doesn't mean there's no risk. There's always going to be risk, and it's speculation. We're trying to beat the markets. It's not easy to do. We're not earning interest or dividends, so it's trading, not investing. So should you day trade at all? Well, I mean, that's a personal choice. I can't answer that for you. But the reason people do day trade, and let me just start by saying day trading is really, really tough. I know it seems easy. Everybody gets excited about it. Your profits and losses are supercharged, but it's really, really tough. Not very many people can do it profitably in the long run. Traders are drawn to day trading because there's a low barrier to entry. The margins are low. So just to give you an idea, the S&P margin is roughly $6,200. So if you position trade E-mini S&P futures, you're looking at over $6,000 at margin. If you're day trading, the margin is a lot low. And day trading means getting in and out within the same trading session. Depending on the brokerage you're using, the same trading session might mean just the official day session, or it actually might mean a 23-hour around-the-clock period. For our clients, it's 23 hours. So, for example, the E-mini S&P opens at, well, it depends on your time zone. I'm just trying to convert in my head. So it opens at 3 o'clock our time, which is 5 o'clock Central. So S&P opens at 5 p.m. Central, and then it trades all the way throughout the night, through the morning, and then it closes again the next day at 2 p.m. So there's a 23-hour period of day trading margins. Futures day trading margins can be as low as $500. So you can see why people go to day trading. Instead of putting $6,000 in an account, they can put a couple thousand in an account and day trade the E-mini. I'm not saying you should. In fact, that kind of leverage usually gets the best of people, but you can, and that's what attracts traders to day trading. People also like the idea of day trading because there's no overnight risk, and that's ironic because I just explained to you that the trading session is actually 23 hours a day. But if you decided to only trade from the morning session through the afternoon session, there's no overnight risk. And let's face it, day trading is exciting. You speed up your profits and losses. Most people are using the same technical indicators for day trading as they use on a daily chart or a weekly chart or a monthly chart. So the idea is, if your technical strategy works on a monthly chart or a weekly chart, it should work on an intraday chart. And the great thing is you're making or losing that money on a daily basis, and so it's faster, it's more exciting, and hopefully it's more profitable, but that's not always how it works out. So the downfall of day trading, it's perhaps too exciting. The flashing lights, the quick fills, the adrenaline, they generally tend to get the best of traders, particularly beginning traders. It takes a lot of hard work and practice, and honestly, it takes a special kind of person to be able to day trade consistently and make money. It's just like not everybody can be an ER doctor because they can't stand the sight of blood. Not everybody can be a day trader. It is what it is. Some of us are born with it, some of us aren't. We're going to show you today a way to day trade that can kind of circumvent all of these things and maybe convert not any personality type, but more personality types into day trading. So day trading magnifies exposure to destructive temptations and obstacles because it's so exciting and so fast-paced. People tend to overtrade, they over-leverage, they're just taking on too much risk. They're swinging for the fence, in other words. They become emotional, they become revengeful, and they're subject to economic announcement volatility. There's a handful of reports that are monthly that trigger relatively big moves, but let's face it, almost every single day at 8:30 a.m. Eastern Time, some sort of news comes out. And even news that isn't expected to move the market, every once in a while can. And in addition to that, we've got political news, trade tariff talks going on. So there's all kinds of things that can throw day trading off. I'm not saying that these types of things can't interfere with a position trading strategy, but they're probably just not as big of obstacles, or they're a little easier to manage in the longer time frame. So the biggest problem with traditional day trading is stop orders. Stop loss orders are meant to protect traders from large losses, but multiple stop losses that are triggered add up quickly. So for example, I see traders all the time, I talk to traders all the time, they want to day trade, they want their risk to be $100 a trade or $200 a trade. So if you're trading crude oil, that's 10 cents or 20 cents. Honestly, you may only lose 20 cents or $200 on a trade, but you're probably going to lose 9 out of 10 trades, maybe more, because you're not giving yourself enough room for error. In the S&P, it's the same thing. The $200 stop is 4 points. 4 points in the S&P is just a hiccup. It's a cough. I know there's some scalpers out there that are actually looking, for very tight profits and that sort of thing, and they think 4 points is a lot, but in the overall scheme of things, 4 points is nothing in the S&P. Today is actually a perfect day to talk about that because the S&P at one point was down 60 points. So you can see stop orders are critical, because if you do have a stop order and it's too tight, you're going to get stopped out over and over and over and over. And a lot of times traders get stopped out right before the market goes the direction that they thought it was going to go. So it's really frustrating. And then that opens another can of emotional decision making, and it just gets ugly from there. On the other hand, if you don't trade with a stop, 99 days out of 100, it's probably going to be okay. The market's probably not going to get out of control, but then you're going to have a day like today where the S&P is down 60 at one point. 60 points is $3,000 per contract. So as you can imagine, if you're day trading the S&P and you lose $3,000 on one trade, it's going to be hard to recover from that. So when it comes to stop orders, again, what we're going to talk about today is how to trade without stop orders, but and still have limited risk. But the idea of, in my opinion, stop orders they create more harm than they save most of the time. And it's kind of like, in sports, your coach always would tell you, play to win, not to lose. Well, that's how I feel about stop orders. When you're placing a tight stop, you're playing not to lose, and that's really, in the long run, it's not going to get you anywhere. You might have a couple of good trades, you might get lucky here and there, but in the long run, you're going to lose money, albeit it might be slowly and a little bit at a time, but you will lose. So day trading with weekly options, and I'm not saying selling options, I'm saying buying these options, being long, eliminates both of these risks. It eliminates the risk of premature stop outs and runaway losses. Okay, so let's talk about how options can mitigate the day trading obstacles that we just talked about. And again, the obstacles are premature stop outs and the emotion that comes with those premature stop outs, or the emotion of being caught on the wrong side of a disastrous move, like I'm sure some traders did today. So just to summarize, make sure you understand what we're looking to do here is we're buying options which have limited risk in exchange for trading the futures. So we're not using options for hedging, which is what we've talked about in a few classes, I think even with this group in the past. But instead of trading futures and then using options to hedge, which we do a lot, we are simply buying options. That's it. If we think the S&P is going up, we buy a call. If we think it's going down, we'll buy a put. We'll show you some examples in a few minutes. So there are even a few more things that we think that obstacles that are solved by trading long options as opposed to trading futures outright. There's no margin concerns. A futures day trader is always playing by the clock. They know when the margin kicks in. So for example, they know when the close is and they know they have to be out of their positions by the close no matter what. Or unless they want to get on their broker's bad side, then I guess they could leave the positions open. But somebody that's trading options doesn't have to worry about it. There is no margin on a long option. So you're not forced out before the close. So if you get into a trade, if you think the S&P is going higher and you buy a call option, but that move does not occur before the close, it's no big deal. You just continue to hold your call option into the close and into the overnight session, and maybe the market will make its move overnight, or maybe it'll make it tomorrow morning, but it's okay. It's no sweat off your back. You did not have to put up the $6,000 per contract for margin. You simply just bought your option and held on to it. It's that easy. So it gives you lasting power. You're less prone to panic, and you don't have to worry about, again, the premature stop outs. So when you're buying options, you're less prone to panic for a couple of reasons. You know your risk is limited. No matter what happens, you always have the ability to recover because you're not at risk of being prematurely stopped out. You buy the call, the market drops like a lead balloon. Your call option is going to lose money. I'm not saying that. But no matter how far the market drops, you always have a chance of being in the trade when the market comes back up. And you can't say that if you're using stops. If you're buying futures and you place a stop and you get stopped out, sure, you can always get back in, but that kind of defeats the purpose. And you're kind of playing a game of, cat and mouse. Also, there's no forced liquidations in options. The most you can ever lose is what you pay for that option. So again, if you buy a call option in the S&P and the market completely crashes, we're talking flash crash kind of stuff, doesn't really matter. The margin department's not going to worry about you. Nobody's going to liquidate your trade. You just hang on and hope that it comes back. And a lot of times it does. Futures traders generally can't do that. They either get stopped out, or they run out of money, or they panic at the lows, or their brokerage firm blows them out. So there's all kinds of things that could happen with that scenario of trading futures. And with options, you're going to see less account volatility. Now, some might see this as a negative, because of course, if you're right, you're going to make a lot less money than you would if you were buying the futures contract outright. But if you're wrong, you're going to lose a lot less. So it goes both ways. I'm more of a fan of less account volatility, because I think in the long run, if you shift the odds in your favor to a point where you're going to keep your emotions in check, I think you're going to have a lot better odds of success. And another thing, I threw this on the slide, minis are not as many as the name implies. So when people talk about the E-mini S&P, they assume that means the risk is low, it's mini, how bad could it be? But trust me, it can move quickly. Again, today's 60-point move, that's $3,000. So don't let the name fool you. Okay, let's talk about weekly options. So I mentioned a few years ago this strategy really didn't exist. And honestly, I don't know of anybody else really talking about it other than us. I haven't seen anything else about it. I'm not saying that nobody's doing it. In fact, I think it's catching on pretty quickly. But we've brought this to the attention of a lot of traders, and kind of a light bulb goes off. Because prior to weekly options, prior to them existing, E-mini S&P traders were accustomed to working with options that expired every month. They expired on the third Friday of every month. Because these options were monthly, they tend to be expensive. Time is money, so if an option has 3 or 4 weeks to expiration, it's expensive. And what the result was, it really wasn't an instrument you could day trade, because they were so expensive, your risk was huge. And in addition to that, they didn't really move that quickly with the market, because there's so much time until expiration. If the S&P is up 20 points today, people know that there's still 29 days left on that option, and anything can happen. So the options just didn't react quickly with the market. So the only way to do this type of a cheap long option strategy, to day trade or to swing trade, for a couple of days, was if you waited to the very last week of expiration, or maybe even the last couple of days of expiration, and those opportunities only came up once a month, and it just wasn't ideal. So now there are liquid and tradable options in the E-mini S&P that expire every Friday. And actually, to make it even better, the CME, the Chicago Mercantile Exchange, has added Monday and Wednesday weekly options. So there are actually options expiring 3 of the 5 days a week. There's Monday, Wednesday, Friday expirations. So you can pinpoint your speculation to a couple of days. And that is what the key is. That's what makes this so great for day traders. So the first question that most people ask is there enough liquidity in the weekly options? Can you trade them? Are the market makers good enough to create a decent market? And the answer is yes. They are quickly gaining in popularity, and they've actually become highly liquid trading instruments. The bid-ask spread on Friday, on any of the weekly options, whether you're talking Friday, Monday, or Wednesday, is generally 20 cents to 50 cents. So we're talking 50 cents is like $25. 20 cents is closer to 10, 12.50. So somewhere in that ballpark, and that's doable. A day trader, if you catch a move, you can overcome that. In the past, again, like I said, the options didn't move fast enough to overcome the bid-ask spread and the transaction cost. It didn't make it worthwhile. But these options can, and I'm going to show you some examples of just how quickly they can move. So in other words, we're talking bid-ask spread of $10 to $25. And the Friday options are more liquid than the Monday, Wednesday, but they're all tradable. So don't let that slight difference in liquidity make you avoid Monday and Wednesday. Trust me, when it comes down to it, that's not what's going to determine whether you make or lose money. It's going to be your trade and how the market moves and how right or wrong you were. So the daily volume on the Friday weeklies is generally about thousands of contracts per session. It depends on the strike price, and it depends on which Friday you're looking at. But they're extremely liquid, and we've had traders trade hundreds and thousands at a time, and the market just soaks it right up. It's not a big deal. Wednesday and Monday volume is generally in the hundreds of contracts. So again, they're a little thinner, but the market makers are willing to play. So if you put an order out there at a fair price, you're going to get filled under most circumstances. And the great thing about these weekly options is they are available 23 hours per day. Market makers are there 23 hours a day. So you can trade these at a fair price around the clock under normal market conditions. And I added that disclaimer there, under normal market conditions, because there are times if China announces a tariff or whatever the news of the day is, that the markets may react in a volatile manner and the market makers will pull back. They'll basically pull their bids and asks for a couple of minutes, but it's usually a few minutes, not hours. It's no big deal. And they have a right. They're making a market. They're taking on risk to take the others, let you execute your trade and take the other side. They have a right to step back and see what's going on before being willing to trade at a reasonable price. I like to call day trading weekly options a poor man's day trading. And it's because it comes with limited risk and, even better, lower risk. Because the delta, which is, if you're not familiar with delta is the rate of change in an option price relative to a futures price. The delta on an option is lower than that of a futures contract. So the profits and losses of any particular trade are going to be much slower than being long or short a futures contract. So to give you an idea of what delta means, if an option has a delta of 50, that means for every point that the S&P moves, the option moves a half a point. It's going to move half as fast. An option that's at the money, meaning the strike price is identical to the price of the S&P, that option is going to have a delta of 50. So if you're buying a call option at the money, it's going to move roughly half as fast as a futures contract. So again, it just slows things down. You might be asking yourself, do weekly options move enough? I just got done telling you the monthly options really didn't. They weren't worthwhile. The weekly options, they do. Because these options expire in a day or two, they get really cheap when the market's moving the other way. And so that creates an opportunity for those willing to buy those options speculating in a reversal. Obviously, because there's a day or two left on the option, it can erode really quickly. That option value can just explode in seconds. So that does happen. But if you happen to catch the direction right and the turn of the market right, you can see some really big moves in those options for very low risk. So again, I guess I could jump the gun on explaining delta, but an at-the-money option has a delta of 50. Therefore, a 10-point move in the E-mini S&P equates to roughly 5-point move in an at-the-money option. So if you went long an S&P and the market went up 10 points, you'd make 500 bucks. If you went long and at the money call, you're probably only going to make about $250. But the same goes on the flip. You're only going to lose $250 if you're wrong. And the great thing about options is you can pick how long you want to be, how aggressive you want to be. You don't have to buy an at the money option. You can buy an out of the money option for cheap, and it's more of a lottery ticket, but and it has a lower delta, but it's a great way to get your foot in the door just in case something big happens with very low risk and low cost. So I just wanted to throw this slide on there to give you an idea of how quickly these options can move. Hopefully my highlighter will work here. Well, yeah, okay. All right, so we're looking at an S&P. At this point, the market's at 2834. Obviously, this is a few months ago, and the S&P is not that high now, but I just wanted to give you an idea of how it works. So the high of the day was 2837. We'll just call it 2840, and the low of the day was 2809, 2810. So we're talking roughly a 30-point range from high to low. And if you want to know, I mean, obviously a futures trader trying to trade that range might have made or lost $1,500. But an option trader could have gotten in with a much less risk, no margin, and a lot less emotion. They wouldn't have made nearly 1,500 bucks, but let's assume someone was savvy enough to catch the high or catch the low. Let's see how much they might have made. So for example, a 2810 put, these are puts over here. It's hard to see that, but these are puts on this side. 2810 put traded as cheap as $2. It's $185, but we'll call it $2. So $2 is $100. And then it traded as expensively as $10. So someone, if they had perfect timing, might have put a $100 bet and turned it into 500 bucks. Obviously, this is a relatively big move in the S&P, but I just want to show you that these options can and do move. We can show something a little more dramatic, I think, over here, just to give you an idea. Keep in mind that options don't trade as fluidly as futures. So when you look at the high-low of a futures price, like when we're looking at the futures 2837 and 2809, we know that those prices actually traded, and there's probably thousands of trades near or at those prices. In options, the price doesn't get onto the high-low board unless it actually trades there. So just because this option has a low of 11 and a high of 26 doesn't mean it didn't get a little cheaper or it didn't get a little more expensive. It just means that's where it traded. The bid-ask spread could have been much different than those prices. But again, we can see that we're talking about a 15-point spread. That's 750 bucks. So if a trader had good timing, and I'm not saying you're ever going to pick the high or the low, but you can see there is some potential here. Someone could have put up a $500 bet and possibly made $750. Over here, we've got a low of 330. That's a $150 risk. Could have maybe turned it into roughly $700-800 bucks. So imagine if you could day trade like that. If you could put up 150 or 200 as a maximum risk, no matter what happens, and if you happen to catch the right move, you could turn that into several $100s. Obviously, it's not that easy. You're not always going to pick the high or the low. But I'm just showing you there is potential there, and it's a much different way of looking at things than trying to buy or sell a futures contract and placing stops and coming with all the different baggages that we've already talked about. So here's where people get turned off by day trading options. When you're trading futures, not options, futures, when you're trading futures, the math is easy. You know exactly how much you're going to make or lose if you buy here and you sell there, or if you buy and the market goes to here. Everybody knows how to calculate the math. But options are more difficult. In fact, when you're calculating the potential profit in options, there's more questions than there are more questions than answers. And this is because unless you're going to hold all the way to expiration, anytime before expiration, there's time value that determines how valuable that option is. That time value is based on time, price, volatility, demand, things that just simply cannot be quantified. So before expiration, it's a little bit of a guessing game. If it is held to expiration, it's easy to know how much you're going to make or lose. What I like to do is I kind of guess at how much I think the option might be worth if the futures price moves in the intended direction and the intended magnitude. So for example, if I have a price target in the S&P that's 20 points higher than the current price, I'll look at the option that has a strike price 20 points below the market. And so I think to myself, okay, if the market moved up 20 points, this option would then be at the money and it would be worth X number of dollars. And so let me we'll show you an example of that as we go. I'm not sure why the graphic, make sure the other ones, I have no idea why the graphic is not showing up in this particular slide. I apologize for that. But we can still hopefully get the idea. So actually, this slide was just explaining the exact same thing we did in the S&P we can do using crude oil options. Crude oil does have weekly options. So you could essentially shop around for options that are 10 to 20 cents, in other words, $100 to $200, and do the same sort of thing. Your total risk is $200, and if crude goes in the intended direction, you stand to make some money. This particular option chain had 7 days to go on these crude options. You'd be surprised at how cheap some of the crude options can get. When the market starts going up, everybody completely ignores the puts and they get cheap, and that's a time where you can maybe get your foot in the door without all the craziness that is crude oil futures. If you've ever tried trading crude oil futures, you know exactly what I mean. Options are definitely the way to go. I apologize that slide's not loading. I don't know why. Let's look at an S&P example. So this is obviously an S&P chart. You can see that the price is bumping up against a trend line. When the market gets up to this trend line, you basically have two choices. You could sell, well, you have a couple, but one choice would be to sell a futures contract. The other would be to purchase a put option. Obviously, if you sell a futures contract and the market in the resistance holds, you stand to make some good money. We're talking, this is deceiving. It looks like a very tight trading range, but this is during a volatile period in the S&P. So we're talking like 27.30 down to 26.85. So we're talking about 45 points. So 45 points obviously is 22.50. So we're talking about roughly $2,000 if you sold a futures contract here and everything worked out. But where do you put your stop? Do you put your stop here? If you do, you're probably going to be stopped out before the market goes your way. Or do you put your stop way up here just as a catastrophic insurance? And that's probably going to work more than it doesn't. But the problem with that is every once in a while, it's going to hit your stop and then come down. And so not only you're going to take a big loss on the trade, but you're going to watch the market go down without you. And it's going to be very frustrating. So the other option would be to buy an option. You buy a 26.80 put, 2 days to expiration for $2.65. That's $132. Notice we're using a strike price down here. Preferably, we'd want to pick a strike price up around this area, but my guess is they were probably really expensive, which is why I used on this particular example, I probably went out a little cheaper. If where you think the S&P might go has options that are too expensive, or you're just not comfortable spending that kind of money, or whatever the case is, don't worry about it. As long as the market goes in that direction, the put options will gain in value usually. I mean, unless it does it very slowly, but if it does it with any type of speed, they'll usually pick up value. So in this example, we're picking the 26.85 put. Even though we don't think the market will necessarily get there, we just think it's going to go closer to 2,700. But if it gets to 2,700, that 26.80 put will be worth more than it is at this point. Okay, so had you been able to purchase the option while the futures contract was pressing up against those resistance level on the trend line, you should have been able to get around $132.50. This gets you into the market with very little risk. There's no risk of premature stop out. There's no risk of runaway losses. If the S&P goes higher, you lose your 132 bucks, or you might even be able to get out with a loss of 50, 60, 70 bucks. It's not going to be the end of the world. If the S&P goes your way, you'd be surprised at how quickly these options can move. And if you're savvy and quick enough, you might pick up a profit. So in the next slide, we can see just how quickly the option moved. Well, actually, I take it back. It's the next slide that's going to show that. But in this particular option, well, let me go back to the other slide. I forgot to point something out. So you'll notice at this point, the S&P, when we purchased the option, the S&P was up 14 points at a price of 27.30, roughly. So, and that ended up being near the high of the day, 27.30, and which is not surprisingly. I just showed you the trend line that suggests that in theory, that area should hold. So we're talking about an S&P up $14 at 27.30. Now let's fast forward to a few minutes later. Okay, this is about 15, 20 minutes later, and the S&P has fell 3 points. So now we're only up 11, we're not up 14. Not a big deal. I mean, not a huge move in the S&P. We mentioned before, that's just a hiccup. But the option is already reacting. It's now trading around 320. We're making 30 bucks. Again, nobody is super excited over 30 bucks, but you get the idea. The S&P barely budged, and we had a very low minimal risk, and we still managed to pick up a few bucks. So it can work if you happen to time it right. A futures trader obviously would have been picking up 3 or 4 points. So they would have been up $150, $200, while this trade is only making 30 bucks. But I'm just trying to give you an idea of how it might work. And obviously, it's a heck of a lot stressful to make or lose 50 to 100 bucks as opposed to $700, $800, $900. So that's kind of what I'm getting at here, but let's take a look at the next slide. So now, the trade that originally went in favor of the option trader is now going against the option trader. So the market's at 27.42. It's up 28. If you remember when we originally got into the trade, it was up 14. Now it's up 28. So not only were we wrong, we were really wrong. Market blew up above resistance, 15 points higher than where it was when we first got in. But the option, I mean, it's lost some value. Obviously, it's lost 80 bucks. That's roughly half of its value, but you're still in the game. This trader may have an option that's worth less than he bought, and it probably on paper doesn't look like the greatest trade ever, but he still has a foot in the door. If the S&P dramatically turns around and collapses, he's still in the trade. A futures trader probably wouldn't say that. A futures trader would be losing roughly 700 on the trade. He's probably sweating a little bit. If he's not using a stop, he's under a little duress. If he did use a stop, he's probably stopped out. The option trader is shrugging like, oops, I made a mistake, but I still have a chance. So we fast forward. I don't know what the time frame was on this, but I think it was about an hour or so, and the market is suddenly back at 27.35. We're only up 21, so we're roughly 8, 9 off the highs. The futures day trader probably would have abandoned ship. He would have been stopped out. He would have been stressed out. And even if he is still hanging on, he really went through a lot of emotional duress. But an out of the money option trader would have been comfortable and actually probably would have played offense rather than defense. So if you find yourself in an option where you're wrong, such as this one, when we bought the 26.80, we paid roughly 130 bucks for it. it fell to half of its value. At that point, it's probably fair to say that one's probably not going to work out. So somebody that's losing 80 bucks might feel comfortable, well, let's just take the loss on that and let's double our bet and purchase something closer to the money. So they could have taken whatever they could to get out of the 2680, bought a 2780, I'm sorry, a 2700 put for roughly 3 points, increasing the delta of the trade, meaning it'll move quicker with the market and putting them in a better shot to recoup losses. And remember, after all of this is said and done, this option has gained in 60 bucks, so we're only down like $10, $15 on the trade. So even though the S&P went against us 15 handles really quickly, we're down 15 bucks. No big deal. So just to give you an idea of how the lasting power can be so useful as an option trader, again, remember we had a trend line here. Obviously, the market popped above the trend line, stopped everybody in their dog out, even went for these stops up here that were placed. You know, everyone tends to place stops around the same area, so I'm pretty sure most of these stops placed up here, this area, were hit, and then the market immediately came back down. Futures trader would have been pulling his hair out, probably lost money, probably walked away from his computer and missed the move. An option trader may not have gotten rich, but this is a nice move. Remember in the last slide, we rolled our strike back up to 2,700. So we took a loss on the option that was down here. We were able to roll our strike up to 2,700, which is roughly in line with the bottom of that trading range. So that puts us in a more ideal position. And we were able to do that because as the market goes up, these options get really cheap because, again, they only have 1 or 2 days to expiration. People know that, so they just lose interest in them and they become cheap. And again, it's a good way to play a real quick swing. So to show you how those options ended, remember the 2680 that we decided to sell and roll up to the 2700? Well, that one actually, even though it went almost worthless at one point, it actually came back and would have returned a profit to a trader. It's now worth about $5. So we originally got in at, I want to say 2-something, $137. Now it's worth roughly $250. So even if you would have just hung on to the original trade, watched it almost go to worthless status, it would have come back for you, would have made 100, 150 bucks on it. The 2700 put that we paid $3 for, our total risk was like 150 bucks. Came back and is worth $500. Okay, so I think it's clear that nobody's going to get rich tomorrow day trading these weekly options. But again, I just want to show you it's a different mindset and it's probably a much better way to do it. A lot less stressful, which means you're going to make better decisions and you're really going to have probably a much better outcome. That said, if this is too boring for you, you can obviously buy options that are closer to the money. So somebody looking to get into a trade here, the market's at 27.12, they could go to these at the money options that are worth 700 bucks, 800 bucks and play those. Those are going to move a lot quicker. Your P&L is going to be a lot more exciting. Or another way you could play it is just trade multiple contracts. So instead of buying one, you could buy 2, 3, 4, 5, whatever it is, and you can supercharge it that way. But again, the point is, most people lose day trading, not because their system is terrible, but because of the emotions involved. They make bad decisions when things go wrong. They make bad decisions when things go right. And this takes away a lot of the emotional component because it's just not quite as stressful. So I also wanted to point out again, the futures price did not have to surpass the option strike price for that option to increase in value. I just showed you that if you would have held on to the 2,700 put, it would have quadrupled or more in value in probably less than an hour. Yet the futures price did not reach, or it actually does eventually, but at this particular time it hadn't reached the strike price yet. So you don't have to, what the misconception is, people assume that the option has to be in the money for you to make money, and that's not true. In the money just means that the futures price is beyond the strike price, and that would be nice, but it's not necessary for you to actually profit. The only thing you need to happen to turn a profit is for the option to increase in value. Again, I also want to point out, weekly options erode really, really quickly, which is why I prefer the idea of trading the out of the money options, because at least your risk is low. So if you pay 150, 200, 250 for an option and the market goes against you, that option is probably going to be worthless pretty quick. I mean, we're talking hours, not days. It'll lose value fast. So if you're spending 200 bucks or less on an option, it's probably not going to be a barn burner. If you're spending $700, $800, $900 to buy an at the money option and it goes against you, you'd be surprised how quick the value can erode. So you want to be careful with that. Okay, so we kind of talked about this, but if you're looking for more action, more profit potential, trade more size, trade multiple lots. The great thing about doing that is if you're and I prefer trading in this situation with this strategy, I would prefer to see somebody trade 2, 3, 4 contracts out of the money than one at the money. And the reason being, you can leg in and leg out. You can peel positions on and off incrementally. Your timing is never going to be perfect. So if you have the ability to buy in increments as the market's going against you and then sell in increments as the market's going in your favor, assuming it does, you're going to be a lot better off. Your average entry and exit price are going to be better than if you just went all in, all at one price at the same time. And a lot of people I know are looking for doubling their account in a week, a month, whatever the case is. But you don't forget that a profit of $50 per day equates to almost $12,000 at the end of the year. So it's not necessarily imperative that you swing for the fence all the time. In fact, 50 bucks a day is not swinging for the fence. It's not much at all. It sounds boring to most people, and it kind of is. But the idea is you don't have to make $1,000 a day to come out ahead at the end of the year. You just have to be consistent and disciplined. And again, it's easier said than done. So a couple things I want to talk about. Obviously, I am a commodity broker. I'm a futures broker. That's what we do. That's how we make our living, so I'm biased. But I can honestly tell you that where you're trading makes a big difference. And it probably doesn't make difference in the way you think it does. So for example, the weekly options that we've talked about today are not available at all futures brokers. In fact, most of them do not allow their clients to trade them. And the reason being, it takes a little bit of market savvy. It takes a little more work on the brokerage part to offer them, because traders don't always necessarily understand option exercises and being assigned futures contracts if they didn't offset their option, and the margin implications of that and all those sorts of things. So it adds a little complication to risk management, and brokerage firms just simply don't want to deal with it. So if you're expecting a deep discount broker to offer weekly options, good luck. Most of them don't. If you want to trade weekly options, make sure that before you open an account, talk to the broker and make sure that they offer it, because again, not everybody does. So with that said, commission does matter, but it doesn't always matter in the way you think. Think of it this way. 1 point in the S&P is 50 bucks. 1 tick in the 30-year bond is $30, well, 31.25. 1 tick in crude oil is $10. So if you're chasing the cheapest commission, which is probably a brokerage firm that's cutting all the corners, not offering certain option months, not offering weekly options, not offering certain strategies. You're trying to save yourself a buck or two in commission, it's probably not going to decide your success or failure. In fact, it's probably going to do more harm than good. I've seen more people try to save $1 and lose thousands of dollars on the other hand because they weren't prepared, they weren't offered the right products, they didn't have the right margin environments. All these different things make a difference. So know what you're doing, know what you're getting into, and do your research. So in conclusion, those that are looking to day trade with lower risk, lower stress, and without the limitations of being completely flat by the close to avoid margin. And if you don't believe how many people are day trading and must get flat and how it moves the market, look at an intraday chart of the E-mini S&P today. As we got about a half hour to the close, the S&P rallied roughly 20 points, a little more than 20 points, and that was all option traders squaring up. I'm sorry, not option futures traders squaring up. And so the day traders really are sometimes caught in wild moves trying to get out of the market. And obviously that works against the trader. So as an option trader, you can avoid all of that hectic mess, scrambling at the end of the day to get flat. There's low barriers to entry, no margin when you're day trading options. There's limited risk. Overnight risk is optional, but even if you do hold an option overnight, it's limited, so you can sleep well at night knowing that the most you can ever lose is what you paid for that option. There's no premature stop outs, no runaway losses. There's lasting power without large drawdowns. Options force traders to have more patience. As we saw in that example, somebody that bought puts in the S&P but was patient enough to actually wait for the trade to materialize would have done well. A futures trader probably couldn't have afforded to have the patience needed to ride that out. And most importantly, it reduces the noise and the stress, which which increases the probability of making good decisions. So I appreciate everybody coming out today. I hope you enjoyed it. If you have any questions or if there's anything we can do for you, you can reach us at our website, decarlitrading.com.
Carly, thank you very much. That was awesome. Very helpful, very useful. We had a question that came through just at the tail end here, and I think you were pretty clear that margin is not required for the strategy. The other side of that question, though, is the 25,000. I'm just going to read it here. 25,000 for the pattern day trade rule affect how much margin that a person would need to trade these options? If I was listening correctly, and you can fail me, pass, fail, right on the spot, no margin required for these, right?
Correct. I believe that what he's talking about is in stocks, not futures. So it's a little different world. But yeah, there's absolutely no margin. In theory, you could day trade these it depends on the broker, but we accept accounts as little as $2,000. So in theory, you could day trade these options in an account starting with $2,000. So there's no margin, and you can do it with very little money.
Very cool. For everyone that's been watching and listening, and we've had a very engaged audience throughout, everyone has hung in through the entire presentation. We're going to make sure that you get a link, not just to the recording, but also with Carly's information. And so if you want to get in touch with her for additional information, either about a brokerage account or the strategy, you'll be able to reach out to her directly. And of course, take advantage of those books. They're fantastic. So Carly, thank you. It was great to have you, as always. And we look forward to posting this recording. Stay cool in that Las Vegas heat.
I'll try. Thank you. I appreciate it.
Of course. All right, everyone. We'll call it good there, and have a good rest of the week, and good luck trading. Take care, everyone. And thanks again, Carly.